When it comes to investing, the S&P 500 is the gold standard. The index contains the 500 largest companies in the United States, the household names we see daily. S&P 500 stocks represent a whopping 80% of the total value of publicly traded stock in the United States. It's also one of the most popular investment vehicles out there, and for good reason. In this video, I'll be covering all the ways that investors outside of the United States can invest in the S&P 500 through index funds. If you're new to these, make sure to watch my previous video, which covers everything you'll need to know to get started. In the words of Warren Buffett, one of the world's most famous investors,
in my view, for most people, the best thing to do is to own the S&P 500.
So let's get into it. I'll start the video by discussing a little bit about the history of the index and how it has risen to have so much importance for the financial markets. I'll then go through the global ETFs that allow investors in nearly every corner of the world, except this one, to invest in the index. And then I'll round off the video with specific New Zealand examples. If you're not from New Zealand, you can simply skip that part. There's a lot of great content I'll be covering, so I hope you enjoy it. The first index in the United States was the Dow Jones Industrial Average, which was launched in 1896 with 30 companies tracked. This paved the way for the idea of an index, which solved a unique issue for those tracking stocks. At that time, there were around 300 publicly traded companies, and without an index, it was hard to reflect the value of all publicly traded companies on the US stock market, and how this changed by the day. So the two blokes that created the index down at the Wall Street Journal solved this issue for a time. By the 1950s, there were significantly more companies publicly traded, as the US at this time was very prosperous. The Standard & Poor's organization created a new index that listed 500 of the largest firms traded in the United States, expanding some of their previous iterations. One of the key reasons for the index was to have a broad base, allowing more companies to be included than the Dow Jones equivalent, which only included 30. This gave the S&P 500 index a reputation for being a better representation on the state of the United States economy and the stock market. In 1976, the first fund to track the index was started by the Vanguard Group. As at the end of 2020, it was reported that over $5 trillion was invested in similar funds tracking the S&P 500. This has grown in recent years as passive investing becomes more popular as an investment strategy. According to reports from S&P Dow Jones, who manage many of these passive indexes, for the past 11 years straight, the majority of professional stock pickers have actually been found to underperform the index. For a company to be included in the index, it must meet 7 criteria. First, it must have a market capitalization, or size, of at least $14.6 billion US. It must be highly liquid to allow the funds to move in and out of the company's stock comfortably. It must also be listed on the NASDAQ or New York Stock Exchange and not be listed anywhere else. It must be a proper limited company that has trading activities, and it must be from the United States. So there you have it. The index is hugely popular. It usually even beats the professionals, and one of the world's richest men stands by it for the average investor. Let's now explore how to invest in these passive index funds. There are many ETFs, or exchange-traded funds, which closely mimic the performance of the S&P 500. These can be bought from nearly any broker that deals with US stock. These brokers may include Interactive Brokers, or TD Ameritrade, Sharesies and Hatch here in New Zealand, Questrade in Canada, CommSec and Revolut in Australia, among many others. By investing in an ETF, you will essentially own a little portion of each of the 500 companies that are on the S&P 500 index. There are 3 main funds that I'll be covering in this video, ranked by their size. The first is from State Street, also known as SPY or SPY, which is its ticker symbol. The second is provided by iShares BlackRock, known as IVV. And lastly, the third is called the Vanguard Fund, called VOO. There are many others that exist, however these are by far the largest 3, with over $200 billion invested in each. So let's start with SPY. This fund's full name is the SPDR S&P 500 ETF. It is managed by State Street Global Advisors, which is the 3rd largest ETF manager behind Vanguard and BlackRock, which we'll get into later. The SPY ETF is by some margin the world's largest ETF, and was actually the first ETF ever offered in the United States, all the way back in 1993, before passive investing was even popular. Currently, there is around $360 billion invested in the fund, with State Street managing $880 billion across all of their funds. The fees on this fund are currently 0.0945% per annum, or in other words, about $1 for every $1,000 invested. The dividend yield currently on offer, though this is highly variable, is around 1.7%. And there are currently 504 companies currently in the fund. If we look at the historical returns, over the past 10 years, the average return has been around 12% and 9.6% since 1993, which is pretty impressive. The returns are also close to those of the index after we've taken out the fund's annual management fee charges. And if we look at this table of the fund's top holdings, we can see it virtually has no difference with the underlying index, showing it is extremely well managed and is a great place to start looking as we look through our options for a low cost and highly efficient S&P 500 ETF. Next up we have IVV, which has the full name of iShares Core S&P 500 ETF. This fund is managed by BlackRock, which is currently the world's largest asset management company, with just shy of $10 trillion invested with them, around $2 trillion of which is in their ETFs. As a reference for size, that's 50 times larger than the New Zealand economy, so it's a hell of a lot. The IVV index itself has nearly $300 billion invested, making it the second largest S&P 500 index ETF, behind SPY we covered earlier. The fees on this fund are currently 0.03%, making it around 3 times cheaper than the SPY alternative from a fee perspective. The reason why this fund is still smaller than the State Street alternative is that it has much less liquidity. This simply means that there are more trades to buy and sell the units each day, making it easier to buy and sell in large volumes. For the average investor like you and I, this is irrelevant, but for large investors with billions of dollars invested, this is likely to be a much greater concern. As the funds track the same index, the returns are virtually the same between this and the SPY fund. From what I can see, their reweighting date may be different, as this one only contains 503 stocks, not the 504 of the SPY, and the weighting is slightly different. If you're looking for lower fees, but still a large fund manager, this may be worthwhile looking at. And finally, we have VOO, VOO, or the Vanguard S&P 500 ETF. Managed by Vanguard, it has one of the most trusted names in finance behind it. Vanguard has a gold standard reputation in the fund space, with a total $8.1 trillion under management, with $260 billion of this in the VOO fund. This places it third in our list of the top S&P 500 index ETFs. Despite being smaller, Warren Buffett specifically mentions the fund in his will, and his flagship Berkshire Hathaway has invested in the fund along with the State Street offering. Buffett is an advocate of funds with low fees, and this one is no different. Just like the BlackRock fund, this one too has a management fee of 0.03%, which means for every $1,000 you invest, you'd only pay Vanguard 30 cents a year to manage your money. Just like the other two funds we've already covered, the returns are pretty much the same. There's 503 stocks included, and the holdings are only slightly out with the index, but could be explained by different reporting days. Like IVV, this is also a great place to look at for a leading fund manager with low fees. So that rounds out the ETFs which closely track the S&P 500. For those in New Zealand wanting to know more about how they can buy these, you can buy them through the likes of Sharesies, Hatch, Stake, Tiger, and any others that sell US shares. Now we'll be getting into the New Zealand-based funds which provide the same exposure to the S&P 500, but are denominated in the New Zealand dollar. From a tax perspective, these can also be advantageous if you have over $50,000 invested. So if you're based in New Zealand, make sure you stay tuned. First I'll be covering the Smartshares offering, the USF Fund. Then I'll be getting into Kernel's US 500 fund. There are two key similarities. Firstly, they were both denominated in the New Zealand dollar, so you won't need to change your money. And the other is that they both invest in the same Vanguard ETF, the VOO. But let's get into each one separately in a bit more detail. The Smartshares Fund, USF, was created in 2015 to give Kiwis the opportunity to invest in an S&P 500 index fund in the local currency. This allows it to avoid FIF, a significant tax imposed on Kiwis that invest over $50,000 overseas. In exchange for not having to pay the FIF tax, Smartshares charge a higher fee than the underlying fund at 0.34% per annum. Even though Vanguard charges 0.03%, there's a few reasons why Smartshares may be better despite the higher fee. Firstly, as we discussed, if you have over $50,000 invested, you avoid the tax burden which may be higher. Secondly, Smartshares handle all of the foreign exchange costs. Thirdly, if you invest directly with Smartshares through their website, you may avoid having to pay a broker every time you buy and sell. It is also important to highlight that a key difference between this fund and Kernel's is that Smartshares don't hedge their holdings against foreign exchange volatility. What this means is that if you invest in Smartshares, your returns will be very different from the underlying S&P 500 index. If the US dollar appreciates versus the New Zealand dollar, your returns will be higher, and if the opposite occurs, they'll be lower. As a result, because the New Zealand dollar has depreciated in value over the past 10 years, the fund has increased around 15% a year, while the index only increased 12.9%. Aside from this, there isn't much else to say here that wasn't already covered in the Vanguard section. It is a similar story for the Kernel US 500 fund that is also invested in the Vanguard fund, though there are a few key differences. Firstly, Kernel's funds are only available through their website, and you can't purchase units through the likes of Sharesies. Secondly, they charge much lower fees at just 0.25% per year, saving you around 90 cents a year for every $1,000 invested, as opposed to Smartshares. Thirdly, Kernel pays a higher dividend yield at 1.73% per annum, whereas Smartshares only pay out around 0.94%. And lastly, as we covered earlier, Kernel hedges against currency risk to ensure that this doesn't impact returns. This means this fund may be better for those that want their returns to only be influenced by the S&P 500 index alone. So there you have it, guys. I hope you enjoyed this video and learned more about your options when it comes to investing in the S&P 500 from outside of the US. If you enjoyed this video, please make sure to subscribe to my channel to see more content just like this in the personal finance and investing space. Thanks for watching, and I look forward to catching you on the next one. Cheers.